I won't know. But it's not just that, it's they may watch it at 1 o'clock this afternoon.
Oh, I see.
You see what I'm saying?
I see what you're saying.
Okay.
Thank you. Just sitting and chill. Hey, Todd. What's up, buddy? I'm gonna fill in for the finance guru, Jake.
Yeah. Well, I have a really, really good class.
Yeah.
But I need more. I need like a Lonnie and some other guys to help me teach it.
Yes.
And I think it'll be
Some panel people.
yeah, I think it'll be a big, really good class. I'm like, I don't want to halfway do that one.
Of course, because you don't ever do that.
Yeah. Go big or go home. Good job on your YouTube video.
Oh, thank you. I didn't see it. Wait, is there another one? Did I see it?
Oh, see, and then when you get into it, where you can edit it, you can do other things. You might be able to edit this, edit that, and you know. And Donnie, your cameraman.
Yeah, he's about ready to get fired. Yeah, your husband?
Well, like being able to like pan a room while you're talking and be able to open it up as opposed to just being on you. You'll get better as time goes on. But I liked it. It's something that all of us would do.
I'm gonna have to
You
search.
sound just like us. It's great.
Oh,
Laura's got her 19 coats on.
820. 5 Sam. So I'm gonna buy the handheld stabilizer. Which one are you getting? The one that? Whatever Ryan suggested. I need to find that. I need to find one too.
Well, you know what?
Okay,
Honestly, as they critique the video, what would you do differently? Let people tell you. Put it on your Facebook page. Say, please help me. And the agents here have always been super honest.
Have we?
Yeah, sometimes too honest.
I've got a gal, I know a gal who kind of does this a little bit. She said, let me know when you do it again. I'll come and do the filming for you.
Okay.
And
Ryan might help too.
yeah.
He's awesome.
I've been.
Yeah.
Cooper. Oh, yeah.
Where's everybody?
I don't know, man. You might just see me and us.
It's summer.
People. This is it. I remember. Yeah. Is it being Zoom? Also?
It's being recorded too, so they can watch it later. But
So the next week's will be the actual, I think the company that has that finance program for us, you know.
Oh, if they do the app, if we end up getting that, I gotcha, the tracking.
Yeah.
I was wondering, I didn't want to interrupt with that question, but I'm not as concerned about my personal real estate tracking. I mean, it'd be great, but with our investment properties, we're trying to get a lot more systematized and track much better. So I was wondering if it would work for that.
I thought there's something like maybe an add-on or something that each individual can do, but it'll do profit loss and everything.
hey,
But I think
you gonna sit in this class? You gonna sit in the class?
I heard there was a lender talking about a mortgage product.
Well, you're one of my go-tos.
Is that right?
It's on HomeLight. Tony's done 2.
Really?
Wow.
Oh.
Well, so you know, having an agent that can attest to kind of, the fact that it does work is, I'm sure, reinforces everything. So
I mean, you can start.
would you like some paperwork?
Got a pen. They're in my car. My good one.
What is that? How many of them do you have?
Get one for the bank.
Don't you have like 300?
Pen?
Yeah.
I didn't
it's
bring
the
it.
worst.
You have to go to your car to get the pens?
Yeah.
Okay.
I guess I can, the combat went right as well. I'll go to my car. I'll hurry.
Hurry.
I need a battery for my coat.
Okay. Start.
You know it's gonna be a heat index like 100 today.
She's like in the hunt. She's in the blind apparently, and it's 40 below.
Yeah.
Lord.
Yeah.
Well, so far.
Hurry.
The iron.
Yeah.
She has a battery operated Baxter jacket.
I have a scarf like that. that I wear in the dead
Did
of
you see the
winter.
Miami Dolphins Chiefs playoff game
Mhm,
where it was like -27 and Patrick's helmet explodes?
yes.
That's the coolest I've ever been in my life. Nor do I never want to be there again.
Was that the January, like
She
New
would
Year's?
die. Yeah. It was, yeah.
Yeah,
It was
Doug and
tough.
Jake were there too, yeah. They had all their hunting gear though.
Well, and see, I went to Cabela's about 5 hours before game
Yeah.
time, and I spent way too much money on things, and it was cleared out. So of course, all the normal brand stuff that's fairly reasonable gone.
Gone.
Todd goes up here to top tier that no one
Yeah.
buys. The
You get like
$240 item for plug-in socks was available or whatever.
Yes.
We got goggles, and that
They
saved
did
us.
too.
Lonnie goes, I'm buying goggles. So Lonnie buys
Yeah.
me goggles, like $75, whatever, and that changed everything.
Yeah.
Not having that glare in your eyes.
It depended on where the wind was, 'cause like the guys took goggles, but the wind was at their back more, so they didn't end up necessarily needing them. But they, Doug said when he got out, because he can't wear it in the car to get there, it was too hot.
Right.
So he got to the parking lot, got out, he had to get back in
Well, I
halfway
did
through
that.
dressing and then get back out, because he couldn't even, and he kept it hanging in it.
We all got back to the car. Lonnie starts it. We start just taking off
Yeah.
the layer and layer, throwing it in the back, and then running in. And you're right. I mean,
Mhm.
in 25 or 30 seconds, it's
Yeah.
too cold to be out there.
It was insane.
Yeah.
I was like, you guys are nuts.
It was
You're the
dumb.
people that put your window down this far. for
That's
us
right.
to see you.
Yeah.
It's so cold.
Is that when everybody's eyeballs froze?
Yeah. Well, I mean, if you had a drink and did just what Tony just did, the second you broke the
Yeah.
seal, it goes and it just completely froze.
Like an
You
icy.
could see the water bottle go
Wow.
right up it. I mean, it might be the coolest thing I've seen.
Brutal.
The beers went right over the top, and it looked like
Oh my
a.
gosh.
I had water bottles in a heated booth and they still froze. on sides.
Oh my gosh.
I have never been to a Chiefs game,
Mm.
ever, in my whole life. And I was offered so many free tickets that game, and I said no.
Well, you should never.
Well, the tickets were valued at around 800, 900 a piece. By the time I got mine sold, they were $50 each.
Yeah.
And the face value on them was probably $325 or something like that. No, but I mean, as the week was going on, the temperature kept dropping. The projected temperature, it was terrible, terrible. All right. It was terrible. I was saying, we paid to be there. You got paid to be there. All right. We got 4 of us here. So and we're being recorded so people can watch it later. So that's a cool thing. So I talk about this HomeLight program. Today I'm going to talk about HomeLight. But before we do that, I came up with a little vocabulary page. Okay. This will help us. Now, you guys hear the terms. That is you.
Sounds like it's not white though.
Where's the video? Wow. Woo. All right. So you've heard of the terms Fannie Mae and Freddie Mac. Do you guys what Fannie Mae who knows what Fannie and Freddie actually are? Those are abbreviated names, Fannie, Freddie. Do we know what they are? Not government. Basically, it's the agencies. It's the agency guidelines that lenders use for conventional loans only. Not FHA, not VA, not USDA. Those are government. So Fannie and Freddie is not a government agency, but they have a name for it. They call it like a quasi-government agency because it does have some control. The bottom line is it's private. So Fannie and Freddie are for-profit companies. So they're traded, stock, things like that, right? So, but Fannie and Freddie have guidelines. So the reason that's important is because when a lender does a conventional loan, they have to abide by the same set of rules. So all lenders that are doing conventional, conforming, Fannie Mae, Freddie Mac, another word I use is conforming. When they do a conventional loan, that 99.9% of conventional loans, they're conforming to these guidelines, Fannie and Freddie. Well, like verifying 2 years of employment, making sure your FICO scores are above a certain level. If you've had a bankruptcy in the last 7 years, it's ineligible. There's a few idiosyncrasies that Fannie and Freddie that they have in their guidelines. So one big Fannie Freddie guideline that is a way to help a borrower is if you're selling your home, let's back up. So let's go to the next one was debt to income ratio, DTI. Do we understand what debt to income ratio is? Debt on top, income on bottom. And the percentage has to be, what do you know what the maximum Fannie Freddie conforming debt to income ratio is? Yeah, that is way too low. That would not work for most humans today. It's 50%. So agency guidelines for a lender like Fairway is 50%. So if you make, like, let's do a perfect example. I have a client right now. She's single gal. She makes $80,000 a year. She has a phenomenal job. That's a hell of a job, right? 80,000. So what's $80,000 annually? Break that into monthly gross. What is that? Divided by 12. 6666. Okay. So if somebody makes $6,666 and the debt to income ratio is 50% max, how much is that? What's 50% of 6666? 33. So that's the number that I immediately default to in my brain. I'm going 50%. And then from there, that is all of her monthly debt that we consider a debt. We don't count utilities and car insurance, but her current mortgage, her car, her credit card minimums, any student loans. So write this down. Her current mortgage payment is $1,850.
You did not tell me we're actually mad.
I know, right? I know. Well, it's good for you. 1850 is her current mortgage. Her car is $550. Her credit card minimum is $100. That's all her debt. So she doesn't carry a lot of debt. So add that up.
How much is credit card minimum?
100 bucks. We'll keep it simple. 2,500? Sound right? I believe so. 24 plus 100. Yeah. So 2,500. So if you took 3333 and took away 2,500, that's what would be left for a new house payment. What is that? Okay. Can you possibly find them a home for $833 a month? Difficult. Well, that's the current mortgage payment. Yeah, that's total. That's total everything.
Not alone.
Well, in certain areas, it might be close to 100, probably 80 to 100,000. Yeah. So she's already paying 1,800. So what I'm getting at is this: the terms contingent versus non-contingent. If she said, Tony, I got to buy this house tomorrow, but she doesn't have her house listed, it's not sold, things like that, she's considered contingent, right? Contingent upon something happening, which is selling her home to be able to get her money to buy. So in her case, if we count the mortgage payment against her and we have now $830 left over, that's not really, she doesn't qualify, correct? So she would be contingent. So Tony, you just did a HomeLight product with me a month or two ago in Lee Summit, Missouri, and we got your borrower to completely buy into HomeLight before he didn't even get punched in the face with contingent offers. Because what would have happened in Lee Summit if you'd have brought in an offer contingent? Yeah, in all likelihood, it's not going to happen. Now, I know that I do a lot of rural stuff, and the rural markets might be a little different. You know, the house has been on the market 77 days. That might be a little different. Sellers might take that contingency. But if the whole plan for HomeLight is to remove the contingency. So how they do that and to become non-contingent is they have a caveat in the Fannie Freddie agency guidelines. This is how we're going to get to HomeLight here in a sec. Where if you have your house sold and it's under contract, but they're going through the motions, what's the first step? Inspections. Then the lender does an appraisal. All the things that you guys work in the first 10 days of the contract, right? Well, in the first 10 days, you're going through the motions. And if they're contingent, we know that it's just going to be super difficult, even if it got accepted contingent. What Fannie Freddie's guidelines do is if it's sold, they will remove the 1,850 from her qualifying ratio, even if it's not closed, under one condition: there's no contingencies on that sale, meaning there's nothing left to happen. So if they sold it cash, there's no contingencies. If they sold it with a loan and that lender has already done the appraisal and the title work and we're just waiting on closing day, they don't count the payment. Okay. So that's a neat little loophole that Fannie and Freddie offer. But how often do you have somebody that buys your buyer's house and you don't get the dates lined up, and their sale is going to be after their purchase, and the lender's going, we need them to be back in line, otherwise we count the house payment against them, right? I've only had maybe one time in my career that I can remember. It was Nathan Priest and I. We had a sale here in Raymore, and the lady had an investor buying it. So the investor didn't have any contingencies. So she sold her home with an investor, but they weren't going to close for a couple of months. So I got a letter from the investor saying that, that there were no contingencies, and my underwriter removed her house payment out of her ratio. Now, we got lucky because of the circumstances. Under the circumstances, I was like, I want to get her debt to income ratio down a little bit. And we did that. Okay. Now, what HomeLight does is it guarantees to buy your house. So one of these flyers here says buy before you sell. So essentially, this is going to allow you to not be contingent. So we already established that contingencies are tough, right? But if we have stage one, this is getting approved, there's the house hunting, blah, blah, blah. But bottom line is, from my standpoint, the main thing is HomeLight's going to eliminate the house payment out of your ratio because they're going to guarantee to buy your home. So what they do is they put it in writing that they're going to purchase your home, but they're not closing for a long time. So that purchase agreement has no contingencies, like they're not subject to appraisals, blah, blah, blah. Therefore, we remove the obligation out of the customer's debt to income ratio. So what do we have left? What did we say? 833? Add 1850 back into that. Now, how much house does she qualify for? Yeah, 2,700-ish. Now, can you get somebody a good house at 2,700 a month? Absolutely. So my customer is going to use HomeLight in this scenario to guarantee the sale of her home. And HomeLight is willing to do this for a fee. It ain't free, right? Nothing's free. So look at on one of the flyers. It may say how much the fees are, but I'll tell you what they are. If they have two options at HomeLight. They can guarantee your sale, which is give you the relief of the contingency. And they can say, well, step 2, do you want a bridge loan? So number 4 on my list is bridge loan. What that means is that they'll provide you a loan. They'll attach it or bridge it to your departing house, your house you're going to sell. And they give you part of your equity for the down payment of what you want to buy. Now, not everybody needs that. In my particular case, my customer, she doesn't want the bridge loan. She has money and savings that she can pull, but she's only going to put a small amount down, 5%, because that's all conventional requires. So I have to figure out how to get her qualified with a 5% down conventional, including all of her debt. And then when she sells her home, she's got a ton of equity in it. She'll come in and she'll get with me and we'll recast her balance. We'll drop her mortgage balance and they'll recalculate her payment based upon the new balance. It's called recasting. It's $500 fee. Fannie and Freddie allow it. Yes.
If somebody were in that situation, they needed the cash for the down payment, they weren't necessarily doing the HomeLight program. Can they use a HELOC to get their down payment?
If they have a HELOC in existence, absolutely. But the lender has to qualify the new HELOC payment into their debt to income ratio. Does that make sense? I just closed a loan a few weeks ago. One of the agents in this office did exactly that. There was a home equity line involved. They didn't have anything drawn on it at the time. We went to the bank, got the terms of the home equity line. They pulled $45,000 out. We got a payment of $271 or whatever, and then I had to add that into their debt.
Yeah.
And then we showed.
Get it a quicker way if everything else aligned.
And generally cheaper than a bridge loan, because most bridge loans, if you go to the bank and get a bridge loan, like you walked over to Country Club, I mean, it's going to have some fee structure in it and all that stuff. It's not cheap or free. But the problem with the bridge loan, the normal average bridge loan versus HomeLight's bridge loan, there's a payment on a bridge loan. HomeLight doesn't have a payment. And that's the beautiful thing of the bridge is And Tony and I just did one a few weeks ago. He's got another one in the hopper right now, closing in about 2 weeks. Is the bridge loan through HomeLight doesn't have a monthly payment, doesn't have any interest. So it's a beautiful piece to allow them. But HomeLight went in, they looked at their house that they were going to guarantee to buy, and they decided how much equity they would give them. They don't give it all. In fact, they give a formula based upon what they think it's worth. They do a quick, electronic, the term that is AVA, like a valuation model, AVM, and they do a quick AVM and they say, okay, Tony thinks it's worth 410. He's going to list it for 410 when he's ready to sell it. They get in the system and they think it's worth 398. Okay, so they do all the comps just like you guys do, and then they give a percentage of 398 minus his current loan, and that was how much they'll give you. So I did the math on that particular guy. I said, let's just get $65,000. He had more equity than that. Let's get 65K. We'll put 55 of it down, leave 10,000 out to cover your closing costs. And that's what he did. Beautiful. Beautiful. So the reason HomeLight is so critical is it removes any contingency. Now, are all buyers in a position to want to buy without selling? Psychologically, maybe not. Because even though it removes, the key to remember, it removes the payment from my ratio, but does it remove the payment from their actual debt situation? No, they still got to make their payments, right? So HomeLight knows that with a good, go ahead.
Okay, so I thought I heard HomeLight doesn't have a payment.
On the bridge loan, Mm-hmm. But if you were to close before selling, the house that you're selling, you're still making payments on. Even though I removed it from your ratios, that doesn't remove you from the responsibility to make the payment. Make sense? And in most cases, you're going to sell that house pretty quickly. If they have 2 payments in there, there's a delay on the first payment. We got a guy closing July 1. Tony's guy's closing July 1, which by the way, he told me yesterday he's staying at July 1. He's closing July 1. His first payment is August 1 because I made it that way. So if he has a first payment on the new house August 1 and he gets out of his house in July, gets it ready for sale, Tony gets it listed, he'll have probably a month or 2 where he might have 2 payments. And you have to factor that in. These are real things to factor as a buyer. What happens if I have 1 or 2? That it is what it is. That you factor that in your budget. So what I did is I asked to get them a little extra money so they had enough for their closing costs. That way they had that cash still reserves to cover a month or 2 of house payment. Now, HomeLight doesn't want to buy every house out there. In fact, there are houses that they exclude. They exclude anything to do with new construction. Not sure why. And they also exclude anything 55 and older. So if your departing residence, exactly. If your departing residence is in a 55 and older community where that's in the covenants, they won't use that in HomeLight.
Oh, I thought you meant the age of the house.
No. The covenants, the residents. Keep in mind, HomeLight's looking at, if I'm purchasing this home, what are the odds that they do purchase it, and what are the odds that they have to turn around and sell it? So they're not going to be super excited about buying a house that has a limiting number of buyers. Make sense? I mean, every day you guys are looking at the buyer pool of a certain house. I mean, a $750,000 house in Creekmore, the buyer pool is small. The $220,000 house near downtown Lee Summit, buyer pool's big. A lot more people can afford that. Just fact. Or anywhere. Right. In comparison, yeah, 220 in Raymore versus 750 in Raymore. Big difference. So when you limit your buyer pool, you just have that as to how many less people can buy the house. HomeLight knows that they've already learned from experience. They don't want 55 and older communities. They don't want anything over like 10 acres. They have a few weird idiosyncrasies. So what the first thing I do on HomeLight, I get on their website and they say, what's the address of the departing residence, number 5? That's the house they're going to leave, right? I plug that in. It fills it in. It pulls that AVM immediately and knows exactly what kind of house it is. It asks me questions. Does the customer have over a certain FICO score? Because they have a few idiosyncrasies too. They're not going to do things if it's too risky. Okay. So they ask me those questions. Is it over 55 older community? Is it more than 10 acres? And I'm going, no. And then they go to work. to approve the buyer and the house and the departing residents to give them the ability to provide HomeLight services. Now, is it cool? Yeah, it's real cool because you know you're going to sell their home. You just may not be able to line up the dates. And how many people do we know today? I hear this all the time. We need to get our crap out of the house to be able to get it sold. Oh my God. I mean, think of the hurdle you guys go through. Camille Anderson has a house in way out south, that Garden City, I think. And the homeowner needs to get out to sell it. Well, Camille didn't have that luxury. They had nowhere to go. So she busted her butt to get it figured out and get it sold. She priced it right in its current condition, in its current look. And she got a buyer for it. And, you know, would it have been ideal to have that sucker empty and clean? Yeah. But not everybody lives clean, right? Have you ever been into a house that you're showing? You go in and there's just dirty clothes on the floor and the kitchen sink is filled with dishes. I always thought that was odd. Well, I know, but if you have a showing, you're likely to get to clean that. One time we had oh yeah. I know. The 2026, everything stinks. Years ago, my wife and I, we had our house listed in Raymore for sale. And we were moving to another house in Raymore, and the appraiser went and did the appraisal. Well, I had given my son a bath the night before. So in the bathtub, I left the water. And so the appraiser takes a picture and sends it to me the next day and laughs because he's my friend. And he goes, dude, you're leaving bathwater. That's kind of dangerous. And Leanne saw it. She's like, what are you doing leaving water in the bathtub? I know. What am I doing? Dumb dad. It was, unfortunately, you know, Leanne, we went in there and drained. Yeah. Terrible dad is what it was. Bad dad. I did give him a bath. That's it. Hey, I contribute, but I've made only 75% done. I left 25%. I left water and things. Exactly. It's just like, I did laundry. I'm terrible at it. Guess I shouldn't have to worry about it. So think about in terms of, could this benefit your client? Could you see a situation where you've got a house that they need to sell, or they have a ton of equity in it? This is a big drawback now, is they have record equity. So they want to put $300,000 down from their sale. But that's if they're contingent. If they're non-contingent, maybe they can pull $50K out of a 401k, and that'll be their down payment. We structure it so that they put very little down. House payment will scare them. It's higher than they're comfortable with. But when Tony sells their house, he's going to get them that chunk of money, and then they can come to me and we'll recast and lower the payment.
Are there a lot of fees involved in that?
The recast is only $500, one-time fee. Fannie and Freddie charge us $500, so we pass that on. But the beauty of that is they allow us to do it. One time you can do a recast one time on your mortgage, and it's a minimum of. It's correct. You just don't restructure the rate. It's not it's not a refinance. It's a recast. So I've actually had people that want to come in with their money and recast, and we do the math and go, maybe we can reduce your rate from this to this simultaneously to the principal reduction. Then there's possible refinance, but refinancing is a lot more expensive, more than $500. So that's where a loan officer will analyze that with them, where I would sit down and go, does it make sense? What else? Because I'm about to get into HomeLight costs here in a sec. Well, because HomeLight does it, it's not free, right? So
How long before do they give you the stuff?
great question. So the day it closes on the house, you purchase the home using HomeLight, the clock starts ticking. Tony has 21 days to get their house listed and then moved out. That's what HomeLight rules are. This is because they're smart. They know that if we don't get our people moving, it doesn't sell in time. And they'll give you 120 days to get it sold. But here's the inclusive of the 21. Yeah, essentially. But if you get it listed, you can list it anytime. You can list it before they've even moved out, right? Yeah. So the 4-month rule is HomeLight doesn't want to buy your house. They want to get a fee at closing and then go, done. But here's the beauty of HomeLight. Unlike some of the products, these guaranteed sale products like HomeLight, there's a few out there that do it. They're competitors, but they use their own realtor to sell the house. They'll hire who had the house, who the buyer wants to sell the home. Not their.
Oh, Michael.
Yeah. So not, Betty that works for 1% is going to go, HomeLight isn't trying to, they don't want to own your house and they don't care about making the money on that end. Their fees are being generated by what they charge for the service. Boom, go.
The other one's married, 4 kids. Only drag them along paperwork wise, not really understanding.
Right.
And what you do.
What was their impetus? Or is that the house they wanted?
Well, this is my transaction broker.
Tony's on both sides of the transaction.
But it's just getting them to understand certain things. Part of the benefit to that is we're getting ready to sell their house to them. We've already had full inspection.
Mhm.
We've already had an appraisal on it. No, we didn't get appraisal yet, but they already did their engineering.
Mm-hmm.
So, which also helps me with my pricing of it too, so that I have no company.
Mhm.
So, but we can also close coming in all that, so we have full inspection.
Mhm.
And they didn't come back and want anything done.
Done.
On Kyle, they wanted a few things.
Yeah.
done to the house.
One of the things that HomeLight does, if they're going to go and enter into this contract with your buyer, is they will do a home inspection. So I have a home inspection scheduled tomorrow for my buyer, the lady that makes $80,000 a year, that had to be non-contingent to get her home. They're doing a home inspection tomorrow. The home inspection is then I get it, I upload it to HomeLight. They're looking for things like mold. Tony's guy in Lee Summit had a tiny leak in a downstairs bathroom he hadn't seen in 6 months. Sheetrock had a little bit of mold in it. Guess what? Flag, boom, they wanted that mediated. Had some roof shingles missing, boom, fixed. But the good news is the pre-inspection before you sell, in my opinion, helps you because you already know what needs to get fixed. Wouldn't you say? That's the home buyer pays for it. And, well, I mean, essentially, but then when you go to market the house, you got a home inspection. Yeah. So to me, that's a plus. I look at that as a plus. Yeah. And then he had to go in and get the mold remediated. Therefore, then he decided, I'm gonna change my vanity. I'm gonna get new fixtures, a new faucet. And then he used that as an opportunity to do it. And he did it before he bought his house. So yeah.
Like I'm trying to figure out to define this. Like, no, I have to. They must find the house they want. They
Yeah.
must really know they
Yeah.
want.
I mean, I have dozens and dozens of clients right now that are like, they will get real serious about selling their house when they find the one they want. Well, that's a tough sell. Very tough.
This was
Yeah.
great for us 5, 6, 10 years ago.
Yeah.
We were really seeing things we wanted.
Yeah.
But
Right. Well, you would have had to go conventional as opposed to your 100% disabled husband. VA. Yeah. Right. Right. I mean, what I did a HomeLight with a guy that was adamant that he would never do this. Then he went out to the marketplace and he's like, I'm contingent, but look at my house. I have the best house on the street. The agent should be able to see what I'm going to sell and he wouldn't list his house until he, well, the seller on that house is like, that's awesome. You got a great house. List it for sale and sell it and come back. Period. They didn't want to take contingency. So after they got punched in the face a couple times, then it softened them up a little bit. Like, maybe this contingent, non-contingent thing is legit. I mean, I would say in the last 5 years, 6 years, I don't know, probably COVID-ish, things got weird in the housing industry, and contingencies are just not something we see very often unless the situation changes. Unless the situation changes and the type of home, the location. I'd say in Raymore, it's difficult to get contingencies approved in Raymore, right? if it's in the first 30 days of the sale. If you're a seller, why would you take your house off the market? I mean, there's your argument. If you're the listing agent, of course, if you're the selling agent, like, take it off the market. My house is amazing, right? How many times have I know Nanette has ran back and listed the person's house, got it ready, and then go back and say, well, now we're on the market, right? Now, yeah, yep, right, exactly. Well, Ryan Finn had a fantastic situation. His departing residence, his customer, was buying in Lee Summit, so we already know that non-contingent is an issue. Her house is in Washington State. So when I plugged in the departing residence in HomeLight, guess what? They go all 50 states. They pulled it up and they were totally cool with everything. They were like, we love the house. We love this. She only owes $250 on a house worth $800 because houses are stupid up in Washington State. And so, no, it was not, I mean, it was a little bitty community, tiny little HOA. So but they allowed that house, and then she had her own money for her own down payment on that scenario, so we didn't have to do the bridge loan. But let me tell you the fees, because they're not free. We established that HomeLight wants you to do an inspection on the departing residence. So whatever that costs, and that's your buyer's expense, because that's on their home. And hopefully you can parlay that into using that on when it goes for sale, right? I had a house not too long ago that I sold that they did an inspection on, and it gave me a good list of things to fix because it was a flip for me, and I thought I had everything done. It was perfect. I didn't. So, I argued against a couple things, but then I did a few. And I was okay with that.
Did they use their own?
Yeah. If Tony ordered it through his own people. Now, HomeLight wants to use their own people if you don't have that. They just get on their website and go, okay, who do we have in 64063? Who do we have in this? And they could set it up.
But they let you.
They let you do your own. I would do that all day long. I don't think I would just choose, Barney's inspection company because they're on some list. So they let you decide. Again, all things are favoring the situation for your borrower. Okay. Now, I've had it different ways where we get our money because people, they love their equity in their home. And right now we all know we have record equity in our home because of the market we're in. So if they don't have a lot of liquidity, how do we do this? Well, we have a bridge loan option. If they don't want to do the bridge loan option, then I'll figure something else out. I'll get them we maybe give a gift. We can do whatever normal Fannie Freddie guidelines let us do for down payment. So we can get gift, we can borrow out of 401k. Most 401ks have loan provisions. You can pull a loan out, no penalty. You can put it back after you get your equity. Make sense? Any weird issues on that? Because now I'm going to go into what HomeLight costs. Okay? Because this is important. I want you to write this part down. So we know HomeLight they want an inspection on the departing residence, right? So, which is totally cool because you're going to parlay that inspection into when you list it and sell it. Hey, here's a home inspection. And what I have found is my buyers tend to use the existing home inspection. I don't know if that's the case everywhere, but most of my buyers say, hey, there was already an inspection. So we already knew that this and this needed to be fixed. And if it was 3 weeks earlier, the seller already did it. So then they just checked it and said, hey, cool, they did. Here's the list. They did it all. I mean, you've been down that road, I'm sure. If you're a seller, you get that info in front of you, go, I'll do them. You do it, right? So here's the fee. Let's start with, if they're going to do the guaranteed sale, they're going to guarantee they're going to buy your home. They're going to put it in writing. They charge 1% on the departing resident cost. Everything is deferred until it sells. They don't charge the buyer anything up front. So nothing up front, which helps them with cash, but they're going to charge them 1% or a minimum of $5,000. So if you got a $400,000 house that's departing, it's $5,000. Now, why is that important to your buyer to know they're going to have a fee? But what's the difference between what do you have to overpay to get a seller to accept your contingency? I had one that a buyer paid $15,000 over ask if they would take their contingency. What if we'd have done HomeLight and they would agree to pay 1% on the departing house? They wouldn't have had to overbid for it. Good point. It's an opportunity cost of what the fee is. So to me, I don't think that 1% fee or $5,000 is that big a deal. And if you got into a bidding war, you're going to overpay. You're going to pay more anyway, especially if you're contingent. I mean, if you're up against a contingent offer, it's really not even an issue. If you're a seller and you're getting a contingent offer, you're certainly not discounting it. You're probably going to say, take it up 10,000 for the effort. So if you need the guaranteed sale and a bridge loan, so that the two-headed monster there, 2.4%. Minimum $9,000. So on a smaller priced house, it's $9,000. Tony's people that they're going to close in a few weeks on the HomeLight, they're going to have a $9,000 fee on the parting residence. We're doing both the bridge and we're doing bridge and guaranteed sale. Remember, guaranteed sale removed the payment out of the debt to income ratio. That's why you would need that. And then the bridge loan, he didn't have any liquid cash for a down payment, so we pulled some bridge. 2.4 or a minimum of 9,000. So when you get into certain areas, if you do the math, I don't know what 2.4% of to get to 9,000. But you know, whatever price house that is would be what, 400,000 ish or something like that for, I don't know, 400. So then you're at minimum of $9,000. So if you have a $150,000 house, it's $9,000.
But we're not at 100.
No, you're what, 325 ish or so, 300, $3. Okay. So in his case, he's at $9,000. Yeah. And there's a lot of paperwork that HomeLight sends them. There's a lot of overwhelming paperwork. So I end up answering a lot of questions. A lot of them are numbers. Now, what HomeLight will do, though, in all fairness, is they go, okay, we're going to give you a bridge loan of whatever. And I almost always, they tell me how much I have available, and I usually just cut it down to where I can still get them to qualify, and I don't take all of that money on the bridge. Okay, that makes sense. Yeah, to get $9,000
What I communicate fine.
to the agent. Good, good. They thought that your buyer thought that maybe there was some spam stuff coming over, and they were reluctant to sign it. She texted me with a screenshot. Is this legit? I'm like, it's legit. It's HomeLight. And so, and I get it. You know, in today's world, get all these crazy. I know, right? Yeah, exactly. And then we're gonna pepper them with 25 emails. And they have sign here. Yeah, exactly.
Soon, HomeLight's calling in, I'm the same person they're working. So then I've got a new one for.
I haven't got a new
tiles.
rep. Yeah.
So I've got.
Well, they're a big outfit, and they, you know, I took a loan this last week. I took a HomeLight deal away from one of my competitors, and one of my competitors, good people, good friends of mine, and they're good at what they do. They just don't. They're work for a small mortgage company. A small mortgage company won't partner up with HomeLight. HomeLight wants to have you know, they need to have a certain amount of volume that'll go through. Well, we have 3,500 mortgage loan officers in our company. So they're going to have HomeLight opportunities all over the nation. This little mortgage company is based in Columbia, Missouri. They're not big enough for them to do it. So the buyer went in, was contingent, being pre-approved through that bank. I brought it up to the agent. The agent introduced it. Barbara called me, applies on toddbranson.com. Boom, under contract. Big deal. So, but as a loan officer, we know that contingency is a tough situation for any borrower. And it's frustrating to be contingent. But if we can come up with a possible path to eliminate the contingency, that changes everything. And, you know, the customer's got to, I'm okay with sitting down and going through the risks. What's the risk? You know, what's the discomfort of owning two homes at once? Legit, right?
You also have your HomeLight.
Right. Yeah. That's the other thing. Yeah. Yeah. Now on the guaranteed sale, that's a great point. So what they're going to see in their paperwork, Tony says the house is worth 300, but HomeLight says we're going to guarantee to buy it for 225. But HomeLight isn't trying to resell it and make money. They're just saying, here's what we're going to pay for it, because in the absolute worst case scenario, we buy this thing and we have to sell it and Tony only gets 278 out of it, then they got some cushion in there to get everything paid, get them paid, and then if there's money left over, check goes to your seller. Have you sold the Lee Summit house yet? No. Okay. So yeah, I think you're in good shape. I saw the listing. It looked pretty good. Yeah. So, you know, I think that there's some idiosyncrasies that you just have to be able to work through to make sure that your customer's okay with. But I can explain all that. But you know, being old school, 33 years as a loan officer, this product came out a couple years ago and I dismissed it. Who cares? Nobody wants that. And then one of my Kansas LOs, we were talking, and he goes, "Hey, I did the guaranteed sale program with HomeLight." Of course, I'm like, "What?" Yeah. And so I made the contact with HomeLight. I called him. We did a 20-minute video one-on-one tutorial where he showed me. I get it. I'm like, well, this is genius. Why the hell am I avoiding this? So I immediately put it into effort, got my first deal at HomeLight. It was smooth and easy. And it was Ryan Finn's deal. And it was no bridge loan. So she just had a 1% fee, minimum of $5,000, right? So she sold her house for, I don't know, $800,000. So she had an $8,000 fee. But she would have never been able to buy her dream home in Lee Summit, Missouri without it. And if you were contingent on a house sale in Washington State, how excited are you at taking that on? Not. I got offered one time, I had a client that wanted to buy my house. They were willing to overpay for it, and they had a house in California. And I'm like, no, I'm sorry, but I don't want your house in California. I don't want anything to do with California. Sell it and come back. You know, now had it been on the market for 120 days, I might have looked at it and said, well, you know, what's the market look like there? And done a little research, but I looked at it online. It's a cool house, but I'm not going to take mine off the market for it. No way.
You have to educate the other realtor about
Mhm.
wow.
I have taken a few minutes to the listing agent to let him know, and I waited until we got to closing, and I said, "Hey, I'm just going to give you can I talk to you for 5 or 10 minutes?" And I spoke to him, and I told this one Lee Summit realtor about it, and I said, "Here's what we did. This borrower doesn't really qualify without selling his home, but we have a product that'll guarantee the purchase of their home." And I walked her through it. I didn't get like this. I didn't teach a class, but I literally told her, "Hey, he's using a specialized program. If you find somebody that, you know, somebody that could need this product, give me a holler. Let's sit down and I'll go over it in more detail with you." Cool. Have her. That's right. Yeah.
Seller can walk away from closing table and not have any clue where the money came from.
Yeah, yeah. Yeah.
They don't know, it's not their house.
Right. We did one out of this office where we had HomeLight as a backup. They got their house under contract. It bailed. They got it under contract again, and we just had HomeLight sitting in the wings waiting, and HomeLight didn't charge any fees for that. So, but his house was listed. They could see all the pictures. They were fine with what it looked like and all that, so they could see it. All right. So the fees, we understand the 1%, the 2.4%, two different animals. Because it's funny, because I've had 2 clients that needed the bridge and 2 clients that didn't, and my 3rd client doesn't. So I mean, I have had my new one. So I've had 5 HomeLights that'll close. So let's talk about how this benefits you. Now, Lonnie always talks about the GCI in this office and stuff like that, per deal, per transaction. Let's just say somebody gets 2.5%, not 3, but even do the math at 2.5. And now you get a $550,000 purchase and a $400,000 sale. You're at $950. What's 2.5% of $950? A lot, right? Was that just shy of 25 grand? And so this product, and it doesn't cost you as the agent anything, doesn't cost me as a loan officer anything. I just have a little bit of knowledge and learn the product. But there's no way that your client, Kyle, would have been able to do this without being non-contingent. You might have been able to finagle the other one because it's your listing to be contingent for a while, but that doesn't help your seller. Doesn't facilitate the transaction. Plus, you need to get him out of his house to get it ready to sell. Fact.
Which that would be, just like with Kyle, live day 20.
Right. Yeah. The one that I did at Washington State, it was live day 21. And the agent up there in Washington, he and I worked well together, and he was getting HomeLight. He was getting HomeLight. Hey, little late to class. I know. I didn't tell him. Jake couldn't do his class today. Text. Yeah. Yeah. Hey, I do too. Don't be busted on that.
Five, you following this?
Yeah. Yeah. It's just Todd. That's all right. All right. So walk me through, give me some questions. All right. What more questions do we have? Because these are good. What do you got? Yeah. Yeah. That's it.
And then if they have to fix
Well, yeah. And then, now I will tell you this on the paperwork, for the HomeLight, the homeowner sees that there's some additional costs, and they see it because it doesn't really cost them anything, but it's money they're gonna hold back out of that bridge loan, or they're gonna advance 90,000 and only give them 75 because they've got some contingency in there to protect them. So Schroet came to me yesterday and he's like, "What's the 93,000 versus 75,000?" I said, "That's a contingency that they're holding in case they have to fix your home if they buy it." And then they distribute it all back once it's sold. Yeah. I mean, the goal, you can kind of see the goal. The goal is Tony sell it. We charge the 1% or 2.4% or $9,000 or whatever, and they walk away. They don't want to buy the house. I promise they don't want to buy it.
That's part of the communication I do with, they're trying to make sure that these agents understand. If it doesn't sell in the meantime, they have to transition to the owner, that it's a simple transition into you taking it and sell, basically on behalf of.
Yeah. So absolutely. Yeah. Yeah. I don't know if it's Zillow or one of those competitors tried this. Somebody big tried this and failed. But they tried to use their own discount agents to sell it, thinking that if they had their own what?
There is a group out there.
Yeah. And they're basically going to say, well, if your agent can't do it in 120 days, our agent, Buffy that works for 0.5%, she's going to take it over. The likelihood is virtually zero, right? So they keep that continuity going with the current agent, which I think is huge. I don't want to take any business away from you guys. I want you to get it. And if you got a little bit unique property, first of all, if it's super unique, HomeLight probably didn't want to buy it anyway. They won't enter in the product. Other than that, if you price it correctly, it's going to sell.
It's only smart.
Yeah, exactly. Yeah. Right. Who wants to list with 0.5% Buffy? If no one wants that. So does that, can you see where the benefit with this would be? Now, let's answer some questions. Is this available for FHA, VA, or USDA loans? No, conventional only. Fannie and Freddie, those are the agency that we establish our guidelines with for conventional lending. Make sense? Now, my buddies that have banks that are just doing a bank, we've heard a portfolio loan or something like that, they're going to just put it over here on the bank shelf. That's not a conforming product. Doesn't work for this. They know that Fannie and Freddie have certain guidelines that are going to be strict enough that HomeLight feels comfortable that worst case, that buyer gets into this new house. They didn't go cuckoo. They didn't have 100% debt ratio. They didn't have that. They made sure of it because it went conforming Fannie Mae. Yeah. And do you remember what the maximum debt to income ratio is for Fannie Freddie? 50%. Now, some of my competitors out there, guess how high they go? 45. And there's a difference. When you go from 45 to 50, the lender takes on more risk if it defaults. So some lenders out there are going to go, we're not willing to take the risk. So I've had loans, people call me and go, I can't get approved through XYZ. I'm like, oh, okay. They say my debt to income is too high. Well, what they say it was 46. I got to get it under 45. Cool. Apply with me. So let me look at it. And next thing you know, if we're at 46.2, flying hot. We're good. So, but that's the difference between smaller banks and say a big Fairway. I mean, we're a big national company. We're going to definitely offer more products than most people for that reason. But, we're not a teeny tiny little local bank. But all we do are home loans. So we do take that risk of that extra 5% between 45 and 50. We do offer HomeLight. We offer some products these are cool products. I'm pissed at myself that I didn't look at it a couple years ago when when the contingency reared its head a few years ago. I don't know what it was, maybe 2-3 years ago, where the market, people were overbidding and going crazy and going nuts. I wish I would have had this in my back pocket. There could have been an opportunity for maybe one of my buyers that I just didn't get. That had to be contingent. So, but it's educating you guys on contingency and non-contingency. And the last thing you want is a buyer coming to you going, I have a great house in Stonegate. I know I have 200,000 equity. It's going to be amazing. We're not quite ready to list yet, but I want to go look at houses. How many times have you said you can't look at houses if you're not ready to sell? If selling is you're contingent upon selling your house, why don't you talk to Todd and call him and let him run the numbers and see, could we maybe do it a little differently? And if it's the house they really, really want, they start to go, hey, I think we can probably do this product. They start to look at it. I'll walk them through the costs and the fees, and it'll be good.
But either way, some of that buyer is first. I don't know that.
Yeah. But I think that from my perspective, in the last couple months, I've picked up 3 new HomeLight deals, and they have they're not in a position to buy without selling until I walk them through how to do it. Remember, the caveat to Fannie Mae is if they sell their home, it's a guaranteed sale with no contingencies, they'll remove the debt from their debt to income ratio. Because my gal who made 80 grand a year didn't qualify but for an 833 house without selling. 80 is a lot of money. So you can imagine if people make 40 to 50, 60, there's no way they can't do that. Right? So we have to come up with a different way to look at it. And I'm pretty good at figuring out where they can get more money. We're good at that. But if it's an option, HomeLight is a great option if you have a borrower that has equity in their home or whatever that they can use for HomeLight. And in the case that I'm closing 2 of these in July, 3 in July, but the 2 that'll close later in the month, neither one of them are using the bridge loan. They're just getting their 1% fee, $5,000. Yeah. And so I qualified them putting 5% down, not 150,000 from the equity, but 5% down. They got the money. They can do it. I make it fit. So anything else on HomeLight? I mean, if you have questions on it, call me. I mean, shoot me an email, text me, call me, whatever, and I'll go over all that with you. I don't mind. Yeah, I have a PDF. Yeah, if you want the flyer, just let me know. If anybody watches this recording and they want a flyer, let me know. I'll just send it to you. But basically, it's just kind of a way to get that conversation started. Is everybody comfortable buying without selling? No, not at all. But if we walk them through how it's really going to work, and if they have that great house that they think they do, what's the likelihood they'll have multiple payments on the house? Probably not high. Because Tony's likely going to get it sold and get it closed probably before payment 2.
Well, you gotta get 120.
Yeah.
When you start going past the 120, the fees start to happen.
Yeah. Because HomeLight really is going to give them a chance. On Ryan Finn's deal, we got to day 119.
Oh, wow. That's crazy.
But HomeLight was aware, and they knew that they had it under contract, and they knew that it was going because they were in communication with the Washington State agent. The agent in Washington State was communicating. So they were in constant communication because they got it sold at like day 90. And then in Washington, they don't do closings like us. They don't do 22-day closings. They do like 35 days. So it was right at the 120. But they were willing to extend. If it would have been, 123, 124, they were okay with it. Then we're going to force the buy. It was under contract. They don't want to buy the house. Who wants to buy your home? Nobody. They don't. They want They just want to charge the fee, allow you to facilitate the transaction. You list it, you get it sold. And Tony's got his second one that'll close on July 1. Now, Morning View, you can't do it. It's 55 and older. Nothing, no contract on that yet? Oh my God. Crazy. That's
Now, before time, I did my job. I brought 2 cash offers.
yeah, now they're 30,000 below that cash offer they said no to. Uh-huh. So people are scared of it. Yeah. First thing I look at is like, why has this house been listed for 119 days? 155 days? What's going on? Yeah. If they're 100,000 below where they were or something like that. All right. So we can finish the class. Anything else? Feel comfortable that you can at least kind of chat about it. Be smart enough to know that there might be an option. Send it to me. Yeah.
You said conventional, conventional 5%.
Mhm.
What is it?
Well, Fannie and Freddie allow you to put as little as 5% down. They do have a 3% down product, but it's got some unique idiosyncrasies. So let's just go with 5. And then if you have 5% down, you're going to have PMI, private mortgage insurance. That's how you insure it. If it's less than 80% loan to value or less than 20% down payment, you have to insure it against default. That's what PMI is.
But you can never.
No, on conventional loan, it goes away automatically at 78% of the original purchase price. So if somebody paid 100 and they borrowed 90, when it gets to 78,000, it goes away automatically, 78%. Now, that's not considering you didn't go in and try to get it appraised again, things like that. Because a lot of buyers will try to go in and get it reappraised because it's gone up in value to establish that 22%. But conventional loans allow you to do a 95% loan to value or a 5% down. Just you're going to have to pay PMI. Anything else? Yeah. Anything? Sound good? All right. Reach out to me. I'm happy to answer any questions on it. It's a gigantic opportunity when you have the people that they're going to go into a market where no one's going to take a contingency. Yeah, I mean, I hear Lonnie all the time talk about, hey, we had 3 or 4 people that made offers. Immediately you have one that comes in low. Then you have conventional and they're going to put 20% down. That's a possibility. They're going to have this and this much, and then you've got some options. But is one contingent? Boop, right? It just doesn't fly. So, all right. Well, thank you for coming out. Yeah. Yep. I'm happy to do it. If anybody wants a flyer, just let me know. I'll email it to you. Cool.
No, you might.
I thought, I saw that people do that. I don't ever get in that little room. And I'm like, oh, I could probably put some flyers back. I should probably do that now. Well, Christian and I had a deal that he's like, man, I need to know more about this HomeLight. And I said, I did a class on it a year and a half ago when I first started getting into it. Yeah. And how long do you keep it like on your Facebook page where people could go back and watch it? I don't know. But okay. All right, we're good. All right, guys. Thank you. You're welcome. Did you get your domain name?
That's the one, the other one's taken.
Oh, which one was taken?
The one for me.
Lisa, yeah, that's gonna be tough. Big,
Except for fried fishing guys. There you go.
that's cool that was available. I'm surprised that was available. See, in 1999, I just looked it up. ToddBranson.com. Let's see if that's available. And it was available. And I went,
Well, I think
Got it.
that,
yeah. And some people will do the net,
nobody. thinks
but a lot of
that.
people don't think of that.
And that's gonna bounce
And-
back to the other one.
And right. And Matt Davidson has everything Davidson.biz. That's another suffix. So,
I brought it.
all right. Thank you for everything, sir. What was it called? Oh, that's cool. Does he still have it? Always look and see, because you might see that somebody lets it go. Cool. All right, guys. Thank you. Yeah. Becca, can you turn that off? Todd is done. Oh, I thought it was 11.